You know that feeling? Just overwhelmed by all the market news, headlines, numbers, charts flying everywhere. It's hard to know what actually matters.
Oh, absolutely. It's easy to get lost in the noise trying to piece it all together yourself.
Exactly. So that's why we're here. We've got this pretty comprehensive collection of insights and data from a global market strategy team. Think of it like a market guide, and we're going to dive into it.
Yeah, think of us as your navigators for this. Our job today is to slice through all that information, pull out the key trends, maybe flag some surprises, and just help you feel, properly informed about where global markets stand right now.
We'll hit the big economic picture, zoom into places like the US and Europe, look at stocks and bonds, touch on big themes like climate, and even some timeless investing ideas the data brings up.
It's quite a bit, but we'll break it down. Okay, let's get started then, maybe with that global economic overview.
Right, the macro view. Growth first. What are the latest forecasts saying for, say, 2024 and into 2025 across the big economies?
Well, the consensus seems to be for moderate growth globally, but it's definitely not uniform. The U.S. is looking pretty resilient for 2024, maybe around 2.2% growth.
Okay.
But the Eurozone and the U.K. are lagging quite a bit. Forecasts are below 1% for them this year. China's still looking solid, around 5%. Japan more muted.
And looking ahead to 2025,
Yeah.
any shifts?
Yeah, the forecast suggests the U.S. might slow down a touch, but Europe and the U.K. could see a bit of an acceleration, so maybe a rebalancing of growth drivers next year.
Interesting, sort of multi-speed world. How does that show up in real-time business activity, like the PMI numbers, the Purchasing Managers Index?
Exactly. So the PMI gives you that snapshot. Remember, above 50 means expansion, below 50 contraction. And right now, the global manufacturing PMI is hovering just under 50. So stagnation, really.
Okay.
But here's the split again. Developed markets are actually showing contraction in manufacturing, while emerging markets are seeing some modest expansion. It really underlines that uneven picture.
Right. Okay, from growth to prices, inflation, still the big topic, isn't it? What's the latest trend globally?
It's definitely come down a long way from the peaks, that's clear. You look at the charts for the Eurozone, US, UK. Headline inflation is trending lower, getting much closer to those central bank targets now, especially in the UK, actually.
That's a headline. But what about the stickier parts, like business costs or wages? Are those pressures easing too?
That's where it gets a bit more nuanced. Things like the PMI input prices suggest some cost pressures are still lingering, maybe not falling as fast. And wages. Well, wage growth is a big factor, especially for services inflation. It's been running quite strong. Interestingly, it's actually been higher in the Eurozone and UK recently compared to the US.
Okay, so headlines cooling, but maybe some underlying pressures from labor costs sticking around. How are central banks playing this? What's the read on global monetary policy?
Well, the market expectations you see in the data are definitely leaning towards potential rate cuts, particularly for the Fed and the ECB, maybe in the coming months.
Right.
And global financial conditions, basically how easy or tight credit is, they've generally eased off their tightest points from 2022, although they have firmed up a little again recently. But that overall easing suggests maybe policymakers are starting to think about shifting gears.
And the other side of the policy, coin fiscal policy, government spending and debt. Still a big factor after the pandemic.
Oh, absolutely. Government debt as a share of GDP is still very high in places like the U.S., significantly higher than the Eurozone average, for instance.
Yeah.
And government investment growth is also expected to stay stronger than it was in the decade before COVID, so governments are still spending.
Yeah.
That high debt level plus rising interest costs, that's definitely a key backdrop.
Okay, that sets the global stage nicely. Let's zoom in a bit. Starting with the U.S., what's the story there according to this data?
Well, the U.S. consumer is always central, right?
Yep.
Confidence has been, let's say, a bit volatile, but it has shown some improvement lately. One thing that helped was those excess savings built up during the pandemic. Now, the data suggests those are largely used up in the U.S. and the U.K. But interestingly, in places like France and Spain, consumers seem to still have a noticeable buffer compared to their pre-pandemic trends.
Interesting difference. And the U.S. job market, it just keeps surprising, doesn't it? Still strong.
The data definitely confirms that. Unemployment rate is low. Wage growth, like we mentioned, is still pretty robust, around 4%, even if it might be peaking. And job creation, the non-farm payrolls number, keeps showing solid gains month after month. It's still a tight labor market that's supporting those wages.
Okay, let's unpack U.S. inflation a bit more. We know headline is down, but what's actually driving the remaining inflation?
The drivers have really shifted, Energy prices have come down. Core goods prices are pretty flat, maybe even slightly negative. The real stickiness, the persistent pressure is coming from services,
Right.
especially housing costs, what they call shelter, and then other core services, things outside of housing. Those are the components keeping inflation from falling faster, even though their rate of increase is slowing down.
Got it. Okay, turning to Uncle Sam's finances, the deficit and fiscal pressures. What jumps out from the data?
A few things. One, the federal deficit is still large. Two, and this is important, the cost of servicing the national debt, the net interest payments, is becoming a much bigger chunk of that deficit. That's the impact of higher interest rates kicking in.
Right, makes sense.
Forecasts show the deficit staying pretty elevated as a share of GDP. And there's a note in here about the potential expiration of parts of the 2017 Tax Cuts and Jobs Act after 2025 that could really change the government's income picture down the line.
So high debt, rising interest costs, potential tax changes, definitely pressures to watch. The source also mentions trade and immigration briefly.
Yeah, and notes trade policy uncertainty is still elevated, based on the index shown. And tariffs, the effective rate, have been trending up since the 80s, actually. On immigration, the data shows it's become a really significant driver of U.S. population growth recently, sometimes adding more people than births, minus deaths. And it also shows those sharp increases in southwest border encounters.
Okay, comprehensive U.S. picture. Let's hop across the pond. The Eurozone. How does their situation compare?
It's definitely a more mixed picture in the Eurozone. Growth is being driven by consumption and investment, but overall GDP growth has been pretty weak, quite sluggish lately.
And business activity, PMIs.
Again, that split picture. Manufacturing PMI has been signaling contraction for a while now. Services have been more resilient, holding up better, but maybe not exactly booming either.
Okay. And the consumer and labor market over there?
Well, retail sales have been quite weak, actually. And consumer confidence, while it's off its lows, it's still not particularly strong.
I sense a but coming.
But the labor market is surprisingly tight, just like the U.S. in a way. The overall Eurozone unemployment rate has fallen to historical lows, around 6.4%, and wage growth has been really quite strong, maybe even outpacing the U.S. recently.
That's a fascinating contrast, isn't it? Weak confidence in sales, but record low unemployment and strong wages.
It really highlights the complexity, I think. And another key point the data shows is the huge variation within the Eurozone. Germany's unemployment is super low, while Spain's is still way up over 11%. That internal divergence is always a factor.
Understood. How about Eurozone inflation? Similar story to the U.S.
Probably, yes. Headline inflation has dropped significantly. It's now pretty close to the ECB's 2% target.
Okay.
But, like the Fed, the ECB is watching core inflation stripping out energy and food very closely. And especially core services inflation, has been much stickier. It's still running above target.
Energy's been such a massive story for Europe. What's the situation now?
Yeah, the charts on gas imports are dramatic. You see Russian gas imports just plummeting.
Right.
And being replaced largely by increases from Norway and significantly U.S. liquefied natural gas, LNG. That diversification has definitely helped stabilize things, but European gas prices, while way down from the peaks, are still noticeably higher than prices in the U.S.
And one specific area highlighted for Europe is defense spending.
Yes, that's a clear trend reflecting the geopolitical situation. European NATO members have really ramped up defense spending as a share of their GDP since 2014. The average is now collectively above that 2% NATO target, and it's growing faster than other government spending areas.
Okay, let's quickly round out the developed world view, the UK and Japan. Any key takeaways?
The UK shows a similar pattern, actually. Weak manufacturing surveys, but more resilient services. Inflation has fallen there too, but again, core services inflation has been pretty stubborn. The UK data also emphasizes that interplay between the economy and the government's fiscal position, keeping a close eye on tax revenues versus spending.
And Japan. Feels like there's been a real shift there.
There really has.
Yeah.
Growth has been okay, driven partly by consumption and investment. But the big story is wages finally showing clear positive growth and core inflation picking up to levels not seen in decades.
A huge change for Japan.
Absolutely, after years of deflation worries. And the data also highlights that relationship between the weaker yen against the dollar and the rising Totech stock index. Suggests maybe global investors are looking anew, partly helped by that weaker currency boosting exporter earnings.
Okay, fascinating. Lastly, for the regional view, China and emerging markets.
China's growth is still happening, mainly driven by consumption and investment in manufacturing and infrastructure. But the big drag remains real estate investment.
Still weak.
Yeah, property prices are still falling according to the data, and consumer confidence is pretty subdued. Debt is also a complex picture, especially the buildup in local government debt, both on and off balance sheet.
Got it. And emerging markets more broadly.
Well, EM is always diverse, isn't it? But you
Yeah.
see ongoing structural trends like urbanization. Their overall share of the global economy keeps growing.
Right.
One really interesting point the data highlights is how global trade patterns are shifting. Specifically, looking at China's share of U.S. imports. It grew massively after China joined the WTO, but it's actually declined since the U.S. put tariffs in place.
Ah, so others are picking up that share.
Exactly. Countries like Mexico, Canada, Vietnam, you see their share increasing in the data. It's a sign of those supply chains potentially reconfiguring.
Okay, great tour of the world economy. Let's switch gears now to the markets themselves. Asset classes.
That's true.
Starting with equities. How are stocks looking valuation-wise globally?
If you take a broad measure like the MSCI World Index that's mostly developed markets, the forward price-to-earnings ratio, the PE ratio, it's currently trading above its long-term average going back to 1990.
So not exactly cheap on average.
Not cheap relative to history, no. Suggests expectations are, well, reasonably optimistic baked into prices already.
Are there big differences between regions, though? Some cheaper, some
No.
more expensive.
Oh, absolutely. Big differences. The U.S. market really stands out as being the most expensive on that forward PE basis. It's trading well above its own historical average.
And elsewhere.
In contrast, you look at Europe, ex-UK, the UK itself, emerging markets. They're generally trading at discounts compared to the U.S., and in some cases, they're even below their own historical average PE ratios. The charts really show that valuation gap, especially between the U.S. and Europe, UK, widening over the past decade.
Right, so valuations differ. But ultimately, earnings drive stock prices long term. What's the outlook for earnings growth?
That's key, definitely. The consensus forecasts shown in the data are actually pretty solid for global earnings per share, EPS growth, both for 2024 and looking into 2025.
Any regional standouts?
Emerging markets are generally forecast to have stronger EPS growth than developed markets. And another positive sign is earnings revisions. The ratio of analyst upgrades to downgrades is generally above 1 right now.
Meaning more analysts are raising estimates than lowering them.
Exactly. Which suggests growing optimism about future profits. That's usually a good sign for earnings momentum.
And the types of companies in each market differ too, right? The sector mix.
Yes, and that's crucial for understanding valuations and performance. The U.S. market is heavily weighted towards information technology and communication services, the big tech names.
Right.
Whereas European and UK markets have much larger weights in sectors like financials, industrials, materials. So that difference in what you're buying partly explains the valuation gap and why regions perform differently depending on which sectors are doing well.
What about getting income from stocks? Dividends, buybacks?
Different approaches there, too. The U.S. market tends to return more cash via share buybacks, companies buying their own stock back. European and UK markets generally offer higher dividend yields. EM yields are also quite competitive. It's just a different way companies return value to shareholders. Both contribute to total return.
The notes also mention factors like quality stocks outperforming.
Yeah, the data does show that historically, companies with strong balance sheets, stable earnings, low debt, what gets labeled quality one, they have tended to outperform the broader market over the long haul, especially during trickier economic times.
Makes sense.
It also highlights how growth stocks are currently trading at a really significant valuation premium compared to value stocks based on PE ratios. That gap is quite wide right now.
It's always useful to look back at history. The data touches on bull and bear markets.
Yeah, and it's such a crucial perspective. Historically, bear markets, those nasty 20% plus drops, they tend to be much shorter than the bull markets that came before them.
Right.
And the gains in the bull markets are usually much larger in percentage terms than the losses in the bears. It's a reminder that while downturns feel awful, the long-term trend has been powerfully upward, and the good times have historically lasted longer and been stronger.
What about smaller companies versus the giants? Small caps.
In the U.S., small caps have generally underperformed large caps over recent years, actually. Valuation-wise, small caps usually trade at a discount to large caps, but how big that discount is varies. The data lets you compare that across different regions.
Okay, let's dig into U.S. stocks specifically a bit more. We know valuations are high. What else?
Well, on the positive side, S&P 500 earnings estimates have generally been moving higher recently, which has helped support the market's run.
But the valuations.
But the valuations, yeah. Not just the forward PE being above average, but other measures too, like the Shiller KP ratio or price to book. They also suggest the market is expensive compared to history.
Mm-hmm.
And here's a critical point from the data. The forward PE for just the top 10 stocks of the S&P 500 is dramatically higher than the PE for the other 490 stocks.
Wow. That brings us back to that concentration issue, doesn't it? The Magnificent Seven and all that.
Exactly. The data really quantifies it. Shows how those few mega-cap tech-related stocks dominate the S&P 500, not just by market weight, but also contribute a huge share of the index's total R&D spending, free cash flow, even sales. It's a massive dynamic right now.
So U.S. stocks are expensive, driven partly by this concentration. Page 53 in the source connects starting valuations to future returns. What's the takeaway there?
This is a really powerful, sobering chart, I think. It shows a clear historical pattern. The higher the S&P 500 starting PE ratio, the lower the average annual return has been over the next 10 years.
An inverse
A
relationship.
strong inverse relationship historically.
Yeah.
So based purely on that past pattern, the current high valuations would suggest that long-term future returns from U.S. equities might be more moderate than we've seen in periods when valuations started much lower.
Not a prediction, but a historical tendency to be aware of.
Precisely. It's about managing expectations based on history.
Okay, that's crucial. And we saw snapshots for Europe, UK, EM, China, generally showing lower valuations than the US. So wrapping up equities, how has performance looked recently across the globe?
Well, looking at year-to-date for 2024, the U.S. market, the S&P 500, has definitely been a standout performer in U.S. dollar terms, and that's been the pattern for a while now, over the last 10 years, annualized. The U.S. has significantly outperformed most other major markets in dollar terms.
Okay, let's pivot now to fixed income, bonds. What's the yield picture like? Big changes there. Right?
Huge changes. Yields, the income you get from bonds are way up from those ultra-low levels we had for years.
Right.
If you look at developed market government bonds, investment-grade corporate bonds, even high yield, the current yields are significantly higher than their averages from, say, 2015 to 2019. That completely changes the proposition for bond investors. More income up front now.
And what actually makes up the global bond market?
It's enormous, obviously. And the data shows it's really dominated by government debt. U.S. Treasuries are the single biggest slice of the main global bond indexes. And by country, the U.S., Japan, and the Euro area are the biggest issuers.
Does the starting yield matter for future bond returns like it does for stocks?
Yes, and arguably even more directly for bonds. Historically, there's a very strong link between the yield a bond offers when you buy it and the total return you end up getting over the next several years.
How so?
Well, with today's higher yields, the regular interest payment, the coupon, makes up a much bigger part of your expected total return. For much of the last decade, returns came more from bond prices going up as interest rates fell. Now it's much more about collecting that higher starting income.
Which leads to this idea of a yield cushion.
Exactly. The yield cushion just shows how much interest rates could rise over a year before the price decline on your bond completely wipes out the coupon income you received. Higher starting yields mean a bigger cushion. It gives you more protection if rates do rise further. The data shows some scenarios rising rates are still a headwind for bond prices, obviously, but that higher income provides a buffer that wasn't there a few years ago.
Let's look at specific government bond yields. US, Europe, UK, Japan, and importantly, real yields.
Okay, so nominal 10-year yields are roughly U.S. around 4.3%, Eurozone lower at 2.5%, UK near the U.S. at 4.2%, and Japan still very low at 1.0%.
And real yields after inflation.
This is key. Real yields are now positive in the U.S. and the Eurozone for 10-year government bonds. That means investors holding those bonds are potentially earning a return above expected inflation. That hasn't been the case for a long time. It's a significant shift.
The U.S. yield curve has been inverted for ages now. What's the significance of that?
Right. Inverted means short-term yields are higher than long-term yields. The 10-year minus 2-year Treasury yield spread has been negative recently, around minus 40 basis points or so.
And that usually means?
Historically, an inverted curve has often preceded economic slowdowns or recessions. It signals that the market thinks the central bank will eventually have to cut rates because growth is expected to slow. The term premium, the extra yield for holding long bonds, has also been very low.
Okay, moving away from governments to corporate bonds and other credit, what are spreads telling us?
Spreads are just the extra yield you get for taking on credit risk compared to a risk-free government bond.
Right.
Looking at global investment grade, high-yield emerging market debt,
Yeah.
The current spreads are generally pretty close to their historical averages since 2010, maybe even a bit tighter than average.
So the market isn't signaling huge panic about defaults right now.
Doesn't seem to be, no. It suggests markets aren't pricing in widespread credit problems at the moment.
And focusing on high yield, the riskier end of the spectrum.
Yeah, junk bonds. Spreads there are also relatively contained, not excessively wide. And actual default rates have been quite low recently, especially compared to past recessions.
What drives defaults in high yield?
Fundamentals matter. The data shows things like corporate earnings strength tend to correlate with default rates. Interestingly, the data also shows the quality within the high-yield market has improved somewhat, with a larger chunk now in the higher-rated segments of high yield, like BB.
What's actually moving government bond yields day to day?
It's a mix. The data breaks down yield changes into shifts in real yield expectations and shifts in inflation expectations. Recently, movements in both have been playing a role in driving yields up or down.
And finally, for bonds, what have returns looked like lately?
It's been a mixed bag across different fixed income types recently, after a tough couple of years before that. Over the longer term, say the last 10 years, the riskier areas like U.S. high yield and emerging market debt have generally delivered higher total returns than safer government bonds, as you'd expect from the risk-return trade-off.
Okay, covered stocks and bonds. Let's quickly hit a few other insights. Oil prices.
Oil's been volatile, bouncing around in a range mostly. U.S. drilling activity, the rig count, has actually been trending down a bit lately.
And producers.
The data reminds us the U.S., Russia, and Saudi Arabia are still the big three global producers.
Volatility and alternatives, like hedge funds.
The VIX index, the fear gauge, has been relatively low recently, though it can spike quickly. The data here suggests some hedge fund strategies, like macro funds, might offer different return patterns, potentially holding up better during market turmoil compared to just stocks or bonds.
How did alternatives do during that inflation spike in 2022?
Yeah, 2022 was rough for both stocks and bonds. The data shows that while most traditional assets lost money in dollar terms, some alternatives like commodities, infrastructure, maybe direct lending, tended to perform better or even post positive returns. It highlighted their potential diversification or inflation hedging role.
Which brings us to portfolio construction and correlations.
Right. And a key point here is that the correlation between stocks, S&P 500, and U.S. government bonds has actually turned positive recently.
Meaning they move together more.
Yes, which reduces the diversification benefit you traditionally got from holding both. When they move in opposite directions, one cushions the blow from the other. When they move together, that cushion is smaller.
And correlations with private assets?
The data shown suggests correlations between public markets and some private market assets like private equity, real estate, or infrastructure can be lower, potentially offering diversification benefits, although measuring private asset correlations is always tricky.
Okay. Let's shift now to a really big long-term theme, ESG and climate impact. The source has some interesting data points, starting with the impact of actual climate events.
Yeah, it gives a specific example. The estimated impact of the 2022 summer heat wave in Europe, suggesting it added a noticeable amount, percentage points, to annual food inflation that year.
Wow, so a direct economic hit from a physical climate event.
Exactly. Shows how climate risk translates into things like higher prices at the checkout.
What about policy responses like carbon pricing?
Well, the data shows more and more global greenhouse gas emissions are being covered by some kind of carbon price, maybe around 23% now. But the prices themselves vary hugely between different systems, like the EU versus China.
And are they high enough?
According to the IMF recommendation noted here, current prices are generally well below what they think is needed by 2030 to meet climate goals. So, a big gap remains.
Where are the emissions actually coming from globally?
China is the biggest emitter in absolute terms than the U.S., but per person, the U.S. is much higher than China or Europe.
And by sector?
Energy production, industry, transport, buildings. Those are the major global sources. The data also shows projections for how dramatically the energy mix within those sectors would need to shift towards renewables and electricity to hit net zero targets by 2050. A massive transformation needed.
Is investment flowing into climate solutions?
Yes, investment in things like renewables, grids, batteries is growing and projected to reach trillions of dollars annually by 2030 in some scenarios. But there's also a huge gap highlighted in funding for adaptation, especially for developing countries needing money to cope with the climate impacts already happening.
Electric vehicles seem like a big part of the solution story.
Definitely. EV sales have surged. Market share is climbing fast, particularly in China and Europe.
Any related challenges noted?
Yes. The data points out that EVs need a lot more critical minerals, lithium, nickel, cobalt, copper, compared to traditional cars. That creates huge new demands on supply chains and potential bottlenecks or price spikes for those materials.
The source also shows that stark chart of global temperature rise.
Yeah, plotting the temperature anomalies against pre-industrial levels clearly shows the upward warming trend, pushing us closer to critical thresholds.
And despite EV growth, the overall energy mix.
This is all dominated by fossil fuels. The chart shows renewables are growing, but oil, gas, and coal still make up the vast majority of global primary energy consumption. Shows the scale of the transition still required.
There was also data linking droughts and food prices.
Yes, it shows periods where a larger percentage of global land area is affected by drought. And it illustrates a pretty clear historical correlation between those drought periods and spikes in global food prices. Another climate economy linkage.
Finally, on this theme, the market for green bonds.
That market has exploded. Bonds specifically issued to fund environmental projects or social projects or sustainable ones. Green bonds are the biggest chunk. Europe and North America lead in issuance, but it's growing everywhere. It's becoming a major funding channel.
Fascinating and, frankly, quite sobering data on the climate front. Okay, let's wrap up by circling back to some fundamental investing principles. Things this data really underscores, starting with just how long we might live. Life expectancy.
Yeah, that data is quite striking. For a couple both age 65 today, there's almost a 50% chance that at least one of them will live to age 90.
Wow, nearly 50%.
It really hammers home how long retirement can potentially last. 25, 30 years, maybe more. You need a financial plan that can sustain you for a very long time.
And planning for that long definitely brings in the power of compounding, right?
Oh, absolutely. Compounding is like magic, but it takes time. The examples shown are great investing a modest amount annually starting at age 25 versus starting just 10 years later at 35. The difference in the final pot at retirement is enormous, all thanks to those extra 10 years of growth building on growth.
And reinvesting dividends makes a big difference, too.
Huge difference. The chart comparing returns with and without reinvesting income shows just how much of your total long-term return comes from putting those dividends or interest payments back to work.
So what about just holding cash, then? Seems safe.
Safe from market ups and downs, maybe. But the data shows how inflation just eats away at cash over time. Even at a seemingly low 2% inflation, the purchasing power of 100,000 euro gets cut by more than half over 35 years.
So it loses value in real terms.
Exactly. Cash doesn't keep pace with the rising cost of living. It's not a viable long-term strategy for growing wealth or even really preserving it, especially given the inflation numbers we discussed earlier.
The long-term asset return chart showing $1 invested since 1900, that really puts things in perspective.
It's a classic chart for a reason. In real terms, after inflation, $1 invested in equities back in 1900 grew enormously more than $1 in bonds or cash.
Despite all the wars, recessions, crashes.
Despite everything, the annualized real returns confirm equities delivered close to 7% per year over that whole 124-year period, far outpacing bonds and cash. It's the starkest illustration of the long-term wealth-building potential of equities, if you can stay invested.
But that staying invested part is hard because of volatility, right? Stocks jump around a lot year to year.
They certainly do. And the data on annual returns versus intra-year declines makes that point really well. It shows that even in years where the market finished up, there's often a significant drop within that year.
Like a 15% average dip within the year.
Something like that in the example shown, yeah. But the key takeaway is that despite those scary dips, the market ended the calendar year in positive territory most of the time. Focusing only on the temporary declines means you miss the bigger picture of eventual recovery and growth.
Which connects to the fundamental risk-return trade-off.
Precisely. The chart plotting return against volatility, risk for different assets, shows it clearly. If you want the potential for higher long-term returns, like from equities or high-yield bonds, you generally have to accept more bumps along the road, more volatility. Safer assets like cash or government bonds offer lower returns, but a smoother ride.
There was also that chart on fund flows. Seemed relevant to how people actually behave as investors.
Yes, showing money flowing into funds after markets have gone up and sometimes flowing out after they've fallen.
Chasing performance and selling low?
It illustrates that common behavioral pattern, yes. Trying to time the market based on recent performance often leads to buying high and selling low, which is the opposite of what you want to do. That caption, "avoid selling at the bottom," sounds simple, but it's crucial.
And finally, the data on returns after shocks and returns based on how long you hold investments.
Two really powerful points for long-term investors. First, looking back at major crises, wars, financial crashes, pandemics, a diversified portfolio historically recovered and delivered positive returns over the following 1 to 3 years. Markets are resilient over time.
And the holding period data.
That's maybe the most compelling chart. It shows that while the range of possible returns for equities over any single year is huge, big gains, big losses, the longer you hold your investment, the narrower that range of outcomes becomes.
So risk reduces over time.
The range of annualized returns shrinks dramatically. For a 20-year holding period in the U.S. data shown, even the worst 20-year rolling return for equities was positive. It's the strongest argument for patience and focusing on the long term to ride out that short-term volatility.
Wow, okay. We have definitely covered a lot of ground today. From the global economy's pulse down into the details for the US, Europe, China, then diving into what's happening with stocks and bonds, the huge implications of climate change, and finally, those core investing principles that seem to hold true through it all.
It really was a journey through a mountain of data, but hopefully, by filtering it this way, we've pulled out the most important threads and connections for you without causing that information overload we talked about at the start.
Exactly, just trying to surface those essential insights to help you feel more informed. So maybe the final thought to leave everyone with is this. We've seen strong historical evidence about long-term returns, about risk decreasing over longer holding periods. How can really internalizing that help you navigate not just the day-to-day market noise, but also those big, slow-moving shifts we talked about, things like the energy transition or demographic changes or evolving global trade? How does taking that long view really help make